The statement consists broadly of three parts. In the first part, I would dwell upon the MPC's deliberations and the decision of the MPC. In the second part, I propose to give some forward guidance to financial markets. And in the third part, there are certain important announcements that we are making. And finally, as I conclude, I propose to give some I propose to spell out what would be the broad approach of RBI's policy going forward. I request your patience. The newly appointed Monetary Policy Committee, MPC, with Dr. Ashima Goel, Professor Jayant R. Verma, and Dr. Shashank Vide as external members met on 7th, 8th, and 9th October in its first meeting, and the 25th under the monetary policy framework that was instituted in June 2016. I welcome the new members and thank them for their valuable contributions to the setting and conduct of monetary policy in India. I also take this opportunity to thank my colleagues and the teams in Reserve Bank of India for their analytical support and logistic assistance. The MPC evaluated the domestic and global macroeconomic financial conditions and voted unanimously to leave the policy repo rate unchanged at 4%. The MPC also decided to continue with the accommodative stance of monetary policy as long as necessary, at least through the current financial year and into the next year, to revive growth on a durable basis and mitigate the impact of COVID-19 while ensuring that inflation remains within the target going forward. The marginal standing facility rate and the bank rate remain unchanged at 4.2%. The reverse repo rate stands unchanged at 3.35%. Let me take this opportunity to briefly review the state of the economy and its prospects. I have always dared to be an optimist, believing firmly in the ability of humankind to overcome the pandemic. In the months gone by, when COVID-19 raised in fury across the world, our hopefulness might have appeared impudent, like a flame flickering amidst a gathering storm. Today, there is a turn in the wind which suggests that it is not imprudent to dream of a brighter tomorrow, even in the bleakest of times. As Dr. APJ Abdul Kalam, our visionary former president, said, I quote, "You have to dream before your dreams can come true. A dream is not that which you see while sleeping. It is something that does not let you sleep," unquote. After the steep decline into which the global economy plunged in the second quarter of 2020, global economic activity appears to have rebounded sequentially in the third quarter, but unevenly among and within economies. Improvement in manufacturing, labor markets, and retail sales powered strong recoveries in some countries, whereas in others, a rise in new infections prompted a slower pace of unlocking or reimposition of restrictions, which in turn stalled the upturn. Generally, investment has remained in retrenchment, while consumption and exports have started to improve. Massive policy support across all countries has prevented a deeper downslide, providing a floor underneath employment, household incomes, and businesses. Financial conditions continue to remain benign. The Indian economy is entering into a decisive phase in the fight against the pandemic. Relative to pre-COVID levels, several high-frequency indicators are pointing to the easing of contractions in various sectors of the economy and the emergence of impulses of growth. Rather than enumerating them here, I have, in the interest of time, set them out in an annex to this statement, and this statement will be uploaded immediately after I make the statement before camera. By all indications, the deep contractions of Q1 2021 are behind us. Silver linings are visible in the flattening of the active caseload curve across the country. Barring the incidence of a second wave, India stands poised to shrug off the deathly grip of the virus and renew its tryst with pre-COVID growth trajectory. In this environment, the focus must now shift from containment to revival. Undeterred by the pandemic, the rural economy looks resilient. Kharif sowing has steadily surpassed last year's acreage as well as the normal sown area. Improved soil moisture conditions along with healthy reservoir levels have brightened the outlook for the Rabi season. Early estimates suggest that food grain production is set to cross another record in 2021. Job creation under the Mahatma Gandhi National Rural Employment Guarantee Act has provided incomes and employment in rural areas. Meanwhile, migrant labor is returning to work in urban areas and factories and construction activity are coming back to life. This is expect inflation to decline modestly over the next 3 months, indicative of the hope that supply chains are mending. Our projections indicate that inflation would ease closer to the target by Q4 2021. Our other surveys, also conducted in September, indicate that consumer confidence is turning upbeat on the general economic situation, employment and income over a 1 year ahead horizon. While the current assessment of the overall business situation remains in contraction in Q2, it has moved up from a low in Q1. Forward-looking business expectations are optimistic on the overall business situation, production, order books, employment, exports and capacity utilization. The Manufacturing Purchasing Managers Index PMI for September 2020 rose to 56.8, its highest mark since January 2012, supported by acceleration in new orders and production. The services PMI for September at 49.8 remained in contraction but has risen from 41.8 in August. These expectations are also reflected in our growth projections, which suggest that GDP growth may break out of contraction and turn positive by Q4. There is currently an animated debate about the shape of the recovery. Will it be V, U, L or W? More recently, there has also been talk of a K-shaped recovery. In my view, it is likely to be predominantly a 3-speed recovery with individual sectors showing varying paces depending on sector-specific realities. Sectors that would open their accounts the earliest are expected to be those that have shown resilience in the face of the pandemic and are also labor-intensive. Agriculture and allied activities, fast-moving consumer goods, two-wheelers, passenger vehicles and tractors, drugs and pharmaceuticals, and electricity generation, especially renewables, are some of the sectors in this category. In several of these areas, reforms such as agricultural marketing and value chains encompassing cold storage and transport and processing, changes in labor laws, and creation of capacity for production and distribution of vaccines have already opened up new vistas for fresh investments. The second category of sectors to strike firm would comprise sectors where activity is normalizing gradually. The third category of sectors would include the ones which face the slogovers, but they can certainly rescue the innings. These are sectors that are most severely affected by social distancing and are contact intensive. The modest recovery in various high-frequency indicators in September 2020 could strengthen further in the second half of 2021 with progressive unlocking of economic activity. Agriculture and allied activities could well lead the revival by boosting rural demand. Manufacturing firms expect capacity utilization to recover in Q3 2021 and activity to gain some traction from Q3 onwards. Both private investment and exports are likely to be subdued, especially as external demand is still anemic. For the year 2021 as a whole, therefore, real GDP is expected to decline by 9.5%, with risks tilted to the downside. If, however, the current momentum of upturn gains ground, a faster and stronger rebound is eminently feasible. Let me now proceed to give some guidance on in respect of the financial markets. Over the last few weeks, there has been some disconnect between the rationale underlying the RBI's debt management and monetary policy operations on the one hand and expectations in the market on the other. I thought I should take this opportunity to address these issues squarely so that market participants and the RBI share a common set of expectations, which in turn should engender orderly market conditions. As the Monetary Policy Authority with the responsibilities of development and regulation of financial markets and management of public debt, RBI has prioritized the orderly functioning of markets and financial institutions, easing of financial conditions, and provision of adequate system level as well as target liquidity. This is important from the point of view of smooth and seamless transmission of monetary policy impulses as well as the completion of market borrowing programs of the center and states in a non-disruptive manner with a normal evolution of the yield curve. Since February 2020, the RBI has taken a series of measures in this direction. The RBI stands ready to undertake further measures as necessary to assure market participants of access to liquidity and easy finance conditions. Notwithstanding an augmented market borrowing program for 2021, the issuances for the first half of the year have been seamlessly managed both for the center and the states. The weighted average cost of borrowing by central government during the first half of 2021 at 5.82% is the lowest in last 16 years. The weighted average maturity of outstanding stock of the center has also been the highest so far. The RBI has assured that the borrowing program of the center and the states for the rest of 2021 will be completed in a non-disruptive manner without compromising on price and financial stability. In pursuit of this objective, the limit for ways and means advance for the center has been kept at 1,25,000 crores compared to rupees 35,000 crore in second half of the previous year. Similarly, the 60% increase in WMA limit for states in the first half of 2021 has been extended up to 31st March 2021, that is by another 6 months. Market participants should be assured that in keeping with the monetary policy stance announced today, the RBI will maintain comfortable liquidity conditions and will conduct market operations in the form of outright and special open market operations. In response to feedback from market participants, the size of these auctions will from now on be increased to rupees 20,000 crore per auction. It is expected that the market participants will respond positively to this initiative. And immediately after my statement is over today, we will be issuing the notification for the auction, that is for the OMO purchase auction to be conducted next week, and its size will be 20,000 crores. That notification will be issued after this statement is over. Yields in government securities GSEC market, both primary and secondary segments, also need to evolve in alignment with comfortable liquidity conditions. This is important for those segments of financial markets that rely on GSEC yields curve as a benchmark for pricing financial instruments so as to benefit from easy financing conditions engendered by RBI's policy measures and operations. Financial market stability and orderly evolution of the yield curve are public goods, and both market participants and RBI have a shared responsibility in this regard. The augmented borrowing program of 2021 has been necessitated due to the exigencies imposed by the pandemic in the form of the fiscal stimulus and the loss of tax revenue. While this has imposed pressures on the market in the form of expanded supply of paper, the RBI stands ready to conduct market operations as required through a variety of instruments to assuage these pressures, dispel any liquidity in financial markets, and maintain orderly market conditions. Market participants on their part need to take a broader time perspective and display bidding behavior that reflects a sensitivity to the signals from the RBI in the conduct of monetary policy and debt management. We look forward to cooperative solutions for the borrowing program for the second half of the year. It is said that it takes at least two views to make a market, but these views can be competitive without being combative. In this context, it is appropriate that I set out our assessment of the underlying inflation dynamics and the outlook. Abstracting from the period April-May 2020, when imputations imposed a break in CPI inflation series, headline inflation has moved up from March 2020 levels and has persisted above the tolerance band of the target. Our assessment is that it will remain elevated in September print, but ease gradually towards the target over Q3 and Q4. Our analysis also suggests that supply disruptions and associated margins and markups are the major factors driving up inflation. As supply chains are restored, these wedges should dissipate. Meanwhile, aggregate demand remains subdued and there is evidence of considerable resource slack. Large excess supply conditions characterized food grains and horticulture production, and the outlook for agriculture is bright. Crude prices remain range-bound. The MPC has hence decided to look through the current inflation hump as transient and address the more urgent need to revive growth and mitigate the impact of COVID-19. This has provided the space for continuing with the accommodative stance with forward guidance as set out in the MPC's resolution. I now proceed to announce certain additional measures, and they are very important, so I request you to please stand by. Against this backdrop and to provide impetus towards reviving the economy, certain additional measures are being announced today. These measures are intended to, number one, enhance liquidity support for financial markets. Number two, regulatory support to improve the flow of credit to specific sectors within the ambit of the norms for credit discipline. Number three, provide a boost to exports. And number four, deepen financial inclusion and facilitate ease of doing business by upgrading payment system services. The first set of measures relate to liquidity. We propose to announce what is called an on-tap TLTRO. The focus of liquidity measures by the RBI will now include revival of activity in specific sectors that have both backward and forward linkages and multiplier effects on growth. Accordingly, it has been decided to conduct on-tap TLTRO with tenors of up to 3 years for a total amount of about rupees 1 lakh crore. Total amount of rupees 1 lakh crore at a floating rate linked to policy repo rate. The scheme will be available up to 31st March 2021 with flexibility with regard to enhancement of the amount and period after a review of a response to this scheme. Liquidity availed by banks under the scheme has to be deployed in corporate bonds, commercial papers, and non-convertible debentures issued by entities in specific sectors over and above the outstanding level of their investments in such instruments as on September 30, 2020. The liquidity availed under this scheme can also be used to extend bank loans to these sectors. Moreover, banks that have availed of funds earlier under the targeted long-term repo operations, that is TLTRO and TLTRO2, will be given the option of reversing these transactions before maturity. In view of the borrowing requirements of the centre and states in the second half of 2021 and the likely pickup in demand for credit as the recovery gathers strength, on-tap TLTROs are intended to enable banks to conduct their operations smoothly and seamlessly without being hindered by liquidity frictions. The objective is to ensure that liquidity in the system remains comfortable. The details of this scheme as well as the other announcements which I am making will be uploaded immediately after this statement is over. The next announcement under liquidity measures relates to SLR holdings in held to maturity category, that is HTM category. On September 1st, 2020, the RBI increased the investments permitted to be classified as held to maturity HTM from 19.5% to 22% of NDTL in respect of SLR securities acquired on or after 1st September 2020 up to March 31st, 2021. In order to provide certainty to banks as regards their investment and to foster orderly market conditions while ensuring congenial financial costs, it has been decided to extend the dispensation of the enhanced HTM limit of 22% up to March 31st, 2022 for securities acquired between 1st September 2020 and 31st March 2021. It is expected that banks will be able to plan their investments in SLR securities in an optimal manner. The next announcement under liquidity relates to open market operations in state development loans. State development loans in RBI parlance is basically the borrowings done by the security borrowings done by the various states, and RBI conducts them on behalf of the states. In order to impart liquidity to SDLs and thereby facilitate efficient pricing, it has been decided to conduct open market operations in SDLs as a special case during the current financial year. This would improve secondary market activity and rationalize spreads of SDLs over central government securities of comparable maturities. This measure, along with the extension of HTM till March 2022, should ease concerns about illiquidity and absorptive capacity for the total government borrowing in the current year. The next measure relates to, I have now completed the liquidity part. I now would like propose to announce some measure with regard to export support, and this relates to review of system-based automatic caution listing of exporters. Exporters have been adversely impacted by the pandemic-related contraction in external demand. In this environment, it is crucial to provide flexibility to exporters in the realization of export proceeds and to empower them to negotiate better terms with overseas buyers. In order to facilitate the same and make the caution listing process exporter-friendly and equitable, it has been decided to discontinue the system-based automatic caution listing. The RBI will henceforth undertake caution listing on the basis of case-specific recommendations of authorized dealer banks, that is AD banks. I now move on to the set of announcements relating to regulatory measures. At the current juncture, the financial sector has a crucial role in leading the nascent economic revival. It is in this context that the RBI is announcing certain measures aimed at catalyzing augmented credit flows to the productive sectors of the economy. And the first measure relates to revised regulatory limits for retail portfolio of banks. Under the extant framework, the maximum aggregated retail exposure to one counterparty should not exceed the absolute threshold limit of rupees 5 crore. In order to facilitate higher credit flow to this segment, which mainly consists of individuals and small businesses, that is with a turnover of up to rupees 50 crore, and in harmonization with the Basel guidelines, it has been decided to increase this threshold to rupees 7.5 crore in respect of all fresh loans as well as incremental qualifying exposures. This measure is expected to expand credit flow, especially to the small businesses. The next measure relates to rationalization of risk weights on individual housing loans. Under the extant regulations, differential credit weights, risk weights are applicable to individual housing loans based on the size of the loan as well as the loan to value ratio, that is LTV ratio. In recognition of the role of the real sector in generating employment and economic activity, it has been decided to rationalize the risk weights and link them to LTV ratio only for all new housing loans sanctioned up to 31st March 2022. This measure is expected to give a fillip to the real estate sector. I now move on to the announcement under financial inclusion, and this relates to review of the co-origination model in the area of lending. In 2018, RBI put in place a framework for co-origination of loans by banks and a category of non-bank finance companies, that is NBFCs, for lending to priority sector subject to certain conditions. Based on the feedback received from stakeholders, it has been decided to extend the scheme to all NBFCs including HFCs in respect of all eligibility priority sector loans and allow greater operational flexibility to the lending institutions. The co-lending model is expected to leverage the comparative advantages of banks and NBFCs in a collaborative effort and improve the flow of credit to the unserved and underserved sectors of the economy. Finally, I move on to the payment and settlement systems, and this is very important. I am going to announce the round-the-clock availability of real-time gross settlement system, that is round-the-clock availability of the RTGS facility. In December 2019, the RBI made available the National Electronic Fund Transfer, that is NEFT system, on a 24/7/365 basis, and the system has been operating smoothly since then. In order to facilitate swift and seamless payments in real time for domestic businesses and institutions, it has been decided to make available the RTGS system round the clock on all days from December 2020. India will be among the very few countries globally with 24/7/365 large value real-time payment system. This will facilitate innovations in large value payment ecosystem and promote ease of doing business. There is one more announcement, after which I go to the concluding para, where I have attempted to provide some guidance with regard to the RBI's broad approach going forward. The next announcement relates to perpetual validity for certificate of authorization issued to payment system operators, that is PSOs. Under the Payment and Settlement Systems Act 2007, the RBI currently gives on-tap authorization to payment system operators for limited periods of up to 5 years. In order to obviate licensing and business uncertainty for PSOs, it has been decided to grant authorization for all payment system operators, that is PSOs, new applicants as well as existing PSOs, on a perpetual basis subject to certain conditions. This will reduce compliance costs and create a climate conducive for investment activities, increased employment and infusion of new talent and technologies into the value chains. In conclusion, let me state as follows. COVID-19 has tested and severely stretched our resources and our endurance. Our travels are not over yet, and a renewed rise of infections remains a serious risk. We have, however, come far on an untraveled road with self-belief and courage of hope. We will reach deep into our fortitude and inner strength to overcome whatever formidable challenges COVID-19 may unleash going forward. If we have the resolve to be steadfast till we emerge victorious, I am confident we will muster the forces needed to subdue the pandemic. In the words of Mahatma Gandhi, and I quote, "If I have the belief that I can do it, I shall surely acquire the capacity to do it," unquote. Against all odds, we shall strive and revive. Thank you very much. Stay safe, stay well. Namaskar.